Our next guest says he likes discretionary and energy names heading into this week's inflation reports, but he's cautious on the broader markets as we head into September. Ladenburg Thalmann Asset Management CEO Phil Blancato joins us now to break down why he thinks volatility could persist into the fall. Hey, Phil, nice to see you.
Thank you for having me.
So it's just seasonality. September's usually not great.
We got to forget that the starting point of the markets is always history. And you all laid out all the reasons why the labor market's weakening, and it has weakened. It's not as terrible as the headlines make it out to be. You had 400,000 people come back to the labor market, which pushed up the rate a little bit. But the reality is it's harder to find a job than when we were. Seasonality, going back to the beginning of this thing, has always had a tremendous impact. September's far and away the worst month of the year. And when you have a market that's looking for a reason to sell off, whether it's the election, the emotions around it, behavioral finance, or more importantly, a relatively decent earnings season. I'll call it that way because if you strip out the Mag 7, the other ones did okay. There's only 22 stocks beating the S&P on a year-to-date basis after the Mag 7. So it tells you got this fragile market that if you're not careful, the slightest change, slightest narrative in mind, I'm going to challenge you all on this one. I'm not convinced the Fed cuts in September. I don't think they're there. I know I'm probably the only guy in the street saying that.
You don't think the Fed cuts at all in September?
Show me where the real reason is to cut. The labor market hasn't weakened enough to make them take notice. They have not met their price point. Their trend is their friend, but if you look at just the PMI data, what we're going to get this week on CPI, and we're going to get on just pure manufacturing and service sectors, they're softer, but they're not there yet. And I think somehow we've completely forgotten this narrative that they don't like to cut in front of an election, and there's some degree of truth to that. But go one further, I don't believe that they've met their narrative. And if their narrative truly is below trend inflation, they're not there yet. And look at the consumer spending data. The people who make less than $100,000 a year have been smarter about where they're spending data. We saw month-over-month credit card use only go up marginally. So it tells me that the reason why I like Amazon as a stock right now, the smarter consumer is coming to light. And if we get even a modest hint that CPI is not as weak as it's intended to be, I think the comments made this weekend echo where I'm coming from. And by the way, what happens to this market if they don't cut in September? Can you imagine?
Well, I was going to ask you, what do you think will happen? I mean, because the notion here is that the Fed is going to cut in September because it's got a dual mandate, and it highlighted the risk to the other side of the dual mandate in the last press conference. That is employment, and so they have to move in order to preserve the jobs market at this point. But you don't think that happens. So then what is the impact then? So
the impact is they don't cut in September, and we get a significant sell-off. We have a scenario of the market's been waiting with bated breath for this opportunity to see rates cut by the small caps, which sector I like, just not yet, or these other areas of the market besides the Mag 7 that are anxiously waiting for the Fed to reduce interest rates. And you have this scenario where, in fact, if it doesn't happen, it'll be a bloodbath. Not to mention seasonality.
No, Phil mentions consumer revolving credit, I think, was down $1.7 billion. I mean, that's the largest decrease we've seen since, I think, the summer of 21. So I'm glad you pointed it out, which, again, depending on where you look, it's either a great thing or a bad thing. With that said, I agree on the Fed, but have they painted themselves in? They backed themselves in a bit of a corner in terms of September, I would think. And if they didn't move, I'm not quite sure, to your point, what the market would, how we react to that.
What they're going to need is a weaker job number. So let's go at the job number for a second. If you look at truckers, we can't find enough people. But you look at people in restaurants, that sign that says I need help has really come down. When 400 people come into the labor force and it pushes the participation rate up, and suddenly you look at 25 to 50 or 4-year-olds, which is the highest participation rate of our lifetime. Wait a minute, time out. I'd argue the labor force hasn't weakened enough. I know Powell said he wanted 4.5 to 5. And certainly you're in that target range. But I'd argue because of folks being dragged back in, maybe because of 3-4 years of higher inflation. So I think you need sustained real data, i.e. wages. Wages are still higher than inflation. I'd argue, I'll take the other side of so much of the Wall Street argument. I think this battle of inflation, more importantly, the wages, has been the greatest economic impact we've had in decades. Here's why. The people who make less than $100,000 a year, guess what? They survived this bout of inflation, and they finally got the guy who makes $50,000 a year washing dishes in New York City probably makes 65 now. That change, I think, will be profound for the strength of the U.S. consumer for a while to come. And I don't think we're willing to take credence to that, and I think that's why they don't cut.